Hi, everybody. Hey, this is Eric Lay, mortgage lender at Guaranteed Rate in Boise, Idaho, and joined by Charlotte Jean. Charlotte, good morning. How are you?
I'm great. How are you?
Excellent. Thank you so much. Hey, we're back with another episode of our Let's Get Real About Real Estate market update segment, where really Charlotte and I just get on and rap a little bit about something that we're seeing in the mortgage or the real estate industry that we think you need to see a little bit more of. We've been off of the wagon here for a little bit, but we're happy to be back on and back in talking with all of you. So Charlotte, with that, I'll let you take it away before we really get into this.
Okay, absolutely. So, previously we're kind of discussing what we wanted to talk about today. And, there's a lot of talk about inflation and how that affects the housing market. And there's a lot of articles out there talking about all this crazy, everything's, the sky is falling type of stuff. So as usual, let's look at the data. And I know that we wanted to talk a little bit about how inflation affects the housing market. So can you go into why the interest rates have kind of gone the way that they have and what you feel about that?
Yeah. And so we're talking about mortgage rates here because we want to make sure people don't confuse what the Federal Reserve is doing, because it seems like that catches a lot of the headlines, right? Mm-hmm. I mean, you've heard this. Fed raises rates 0.75%. Fed raises rates 0.75%. That's not what we're talking about specifically today, although we're going to touch on that. We're more talking about mortgage rates, which, of course, you and I are very interested in, because when we help people to buy and finance homes, they probably are getting a mortgage most of the time. So let's do a quick little video check. Charlotte, can you see the screen okay that I'm sharing?
Yep.
Okay,
it's good.
Perfect. Well, I wanted to start with sharing this with all of you because what that is the five-year and 10-month window of the average 30-year fixed interest rates. I just took it back to January 1st of 2017 to let you see where rates are over that 5-year and 10-month period. Now, unless you're under a rock, mortgage rates have moved up, and they have moved up high. Charlotte, I know you and I talk about this all the time, but it's really pretty interesting when you take a peek at this chart, because look how fast they have come up, basically since January, or maybe we'll call it December of 2021. We were at a place back then in the low 3%, right, from that chart. Now we're all the way up, if I can get that lined up there, to almost 7% right now. So that's pretty high. And in fact, if you look at that window right there, that's the highest point for that entire window. But what I found was really interesting. I'm going to take this all the way back to 2005, January. Take a look at that. You actually don't see interest rates almost at 7% ever. You almost get there, right? There's 6.8 in July of 06. There is 6.6 in June of 07. You don't see interest rates anywhere basically in the last decade and a half at the level we're at right now. And I just think that historical perspective real quick is important for people to see, because when we see these high interest rates, it's not just high for the recent period, it's high for a decade and a half. It's pretty crazy.
Yeah. How far back do you have to go to get to the 7%?
Why don't we look at the charts and see? So it's pretty crazy. I'm going to take this back to 2000, January. There's your answer. Wow. So if you get back to 2000, it looks like, let's call it March 2002. You literally have to get back truly 20 years, 2 full decades, to see interest rates that were at the levels that we're at right now. And the reason we wanted to come and talk about this today is because, again, there's a lot of misconception in people's minds, I think, maybe because of the mass media getting wrong, which they do get it wrong a lot, about why this is happening right now. So
why is this happening right now?
Yeah, well, first of all, I'll tell you what it's not. It's not the Federal Reserve. And I answer that question so many times. When the Federal Reserve has a meeting, which they're going to have 2 more of them this year, and it will be all over the newspaper and mass media. Fed raises rates. Fed raises rates. Listen right now, everybody, that is not mortgage rates, okay? What they're trying to do is they're trying to raise what's called the federal funds rate, which in turn drives a lot of other interest rates on things that a lot of consumers have, like credit card interest rates, sometimes car loan interest rates, okay? Sometimes even adjustable rate home equity lines of credit that are driven by the prime rate, which usually moves in lockstep with the federal funds rate. It does not directly move 30-year fixed mortgage rates. However, the thing that does drive interest rates on the mortgages we're talking about is inflation. And I want to show you what inflation looks like right now so that you can get the similarity between the mortgages and inflation, and then we'll draw the comparisons together. Okay. So first of all, let's talk really quickly about what inflation is. Inflation, just broad definition, is a period of rising prices in an economy. Now, I think we all can agree right now that we are in an inflationary period because it seems like the prices for everything are rising, right? And we've talked about this on previous episodes of our market update. Gas, food, you name it, everything's more expensive. That bar graph right there, or that line graph, I should say, you can see especially since January, let's call it August of 2021, inflation has been moving up pretty quickly. Mm-hmm. So if you think about what a mortgage is, and I'm talking about a mortgage as an investment tool, because certainly when we buy homes and we don't have all the cash to buy the house, we have to go and get a loan, a mortgage loan, right? Well, somebody is reaping the interest that you're paying on that. Maybe it's the bank, maybe it's an investor at the end of the day. So much like a share of Apple stock that you and I might decide to buy and sell because we love iPhones and Apple Watches and all that stuff, and we want to invest in the company, there might be somebody that wants to invest in a mortgage-backed security. So sometimes we call those MBS, mortgage-backed securities. That mortgage is an investment that somebody, some investor, or it could be parts of investors through a pool, they're going to create that interest as their investment return because they've purchased into that mortgage. So let's just make up an example. Let's say that you have a mortgage of 5% and you're an investor who decides to buy this mortgage for 5%, okay? And just to make the math super simple, let's say it's a $100,000 loan. So 5% of $100,000 is $5,000. Okay, so that investor is going to get $5,000 every single year that they own that mortgage forever for 30 years, right? Mm-hmm. That feels pretty good. But however, if you take that 5% mortgage that you're getting 5% on, and you put that into a period of inflation where the cost of everything is rising, now all of a sudden that $5,000 doesn't quite go as far. Because gas is double the price that it was 2 years ago. The cost of eggs is quadruple the price that it was just a year ago, right? I mean, every single thing, and we could go down the list of things, right? But everything is more expensive. So can you see now what that feels like to the investor who felt pretty good about a 5% mortgage before inflation started kicking up, and now they're like, dang, I tell you, that 5% is not quite paying the bills anymore. So now let's bring that full circle. If I'm an investor, and I know that we're in a period of high inflation, and I'm thinking about purchasing a mortgage, but 5% doesn't quite cut it. Does 5.5% cut it? Maybe, maybe not. If it doesn't, does 6% cut it? Does 7% cut it? Does 8%? Somewhere higher than 5% has to be the place before an investor will say, yep, I'm going to press the buy button and purchase that as an investment. So I hope that kind of brings full circle what inflation and mortgage rates and why that correlation is there.
Yeah, that's really interesting. You had said when we were talking previously that the inflation was really, not the inflation, but the interest rate was really dependent on demand. And so if there's not as many people that are looking to get loans, is that shooting it up as well?
Somewhat, yes, but it's more driven by that end investor, right? Because in the mortgage, I like to call it the mortgage circle of life when I talk on this, there has to be a buyer of that mortgage or else there isn't any mortgage money to lend out, right? There's just a nice little circle of funding that ultimately comes through Fannie Mae and Freddie Mac and those big, we just call those the big agencies, right? That's the conduit for mortgage money in this country. So that demand from end investors or the lack of demand until rates get to a higher point, right? That's truly where the demand is for mortgages and what drives mortgage rates. Now, what you hit on is an important point, though. If people don't want to get mortgage loans because they look at the rate and like, geez, I don't want that mortgage rate. It's pretty high, right? That drives up the demand for housing purchases, especially existing, but also new construction, right? Because, and you would be the better one to answer that question, right? But when you talk about absorption rates, right? Inventory levels, things like that on the real estate market side, that's going to be more driven by investors, or I'm sorry, by consumers wanting to go get mortgages to purchase homes.
Yeah, that makes sense. So where do you see things going?
Yeah, or we're talking about with mortgage rates, correct?
Right.
Yeah, it is so simple and it's so hard to understand at the same time. So I'll just put it there. Once inflation starts to move lower, for the exact reasons that we just explained when we talked about why higher inflation causes mortgage rates to go up, the opposite side of that coin is also true. So when we start to see inflation peak, and maybe it has, maybe it hasn't, right? You have to have enough data looking backwards to tell if we've hit the peak. But when you start to see those inflation levels come down, history shows us you will start to see mortgage rates coming down too. But until we get to a real clearly defined downward trend in inflation, as opposed to the opposite that we're seeing right now, I just don't see any way for interest rates to go down. Now, the Federal Reserve is trying their best to bring inflation down. When they start raising the rates on the federal funds rate that we talked about, and remember, that's rates on your credit cards, that's rates on new car loans if you're getting them, that's rates on home equity lines of credits. There's lots of things that are driven by those rates, okay? When they're trying to raise those rates to slow down consumer spending, it's called demand destruction, that will slow down the economy. And once the spending starts to slow down, then that's when inflation starts to come down, because inflation is just too much money chasing too few goods and services. Well, if you don't have a lot of money chasing it because the cost of everything is expensive,
Right.
that ultimately catches up to everybody and the spending slows down, the economy slows down. More than likely we'll go into an economic recession, which, spoiler alert, don't be afraid of recessions. They always happen. They always will. It's a normal part of a cycle to expect. That will slow down inflation, and that should bring rates down because that's what happens in the past.
Okay. All right. Thank you, Eric. It's so complex. So I really appreciate you taking the time to kind of break it down.
It really is. And at the same time, it's also very simple. But I just want our viewers to really understand and take home one important point. The Federal Reserve gets all of the news and the attention headlines, right? When they raise rates, I can't tell you how many phone calls I get that same day. What are mortgage rates now, Eric? Well, what's kind of funny is that in 2 of the last Federal Reserve rate hikes, our mortgage rates have actually come down after the meeting, which just blows people's minds, right? Yeah. Because that doesn't make sense. So again, real important takeaway for people to get. When the Federal Reserve raises rates, that does not automatically mean that mortgage rates just went up by a like increment.
Okay, good to know. Thank you.
Lots of stuff to unpack there, but I hope it makes sense. So, Charlotte, any other last thoughts or anything to tie up or wrap up on this, especially with regard to housing, because you're our real estate professional and that's your area of expertise?
Well, there is a lot, but just kind of from a high level, we are seeing things kind of slow down. We're seeing that the buyer, demand pool, the buyer pool is a little bit lower. Here in Thurston County, we are also seeing less listings come on, and listings that are active, that pool get larger because the listings are staying on the market longer. So last year we were at about 11 days before it went under contract. We're at 26 now. So if you actually, what I thought was interesting was if you compare August to pre-pandemic 2019 to August of this last year, we're looking at very similar days on market, very similar months of supply of inventory. And so it's really interesting to see that kind of, it's kind of leveling out to a more normal seller's market, a more reasonable seller's market. So it's not necessarily something to be afraid of. So that's a very high level.
More of a traditionally normal market, right? Exactly. Versus what we've had for the last few years. So
exactly.
Yeah, for sure. Well, and again, I think a lot of real estate markets, because when I finance buyers in other areas, I think we're seeing some of the same trends. Every place is local, right? Real estate's hyper local, but boy, I think we're starting to see some of those trends pretty common across the country. So Okay, perfect. Well, let's go ahead and wrap up on that. So again, anybody that's watching this, if you have any questions about purchasing a home, Charlotte's your gal. If you have any questions about mortgage financing, mortgage rates, I'm your guy. Reach out to us. We're here to help and be resources for you. Once we've finished uploading this video, we'll put our contact information for you in the comments down below. So thanks again, Charlotte. Always good to talk to you and catch up. Let's get real about real estate. And we'll be back again soon to talk more. Talk to you soon.
Bye.
Bye.